The hidden risk of traditional diversification. If you have followed us at all, been reading our monthly updates, you know that we've been tracking this pretty closely now for, I know we were talking about it at the beginning of last year. So there's a concept called crisis correlation that hopefully you've heard of, but if not, real briefly, it's important because it's one of the reasons you're here, whether you probably realize it or not. And that is in times of crisis, market turbulence, bear markets, and so on, traditionally non-correlated or lowly correlated assets or investments that are in your portfolio become correlated, or at least much more correlated. And that's not just some concept. You've seen it probably, as Matt mentioned, in your portfolios. You can read about it. There's actually, if you Google that study of traditional asset correlation in the new millennium down below by Chisholm and Chase, you can read more about it and see the history of it. It's been going on for a long time, but increasingly so. And that's what's really interesting for the past 20 years. And this year is absolutely doing exactly like we thought it would. The next time we hit a crisis, and I would call what we're in a crisis. And you can see it doesn't really matter where your money is. And yes, we cherry picked these, but I think we could have picked randomly any combination of asset groups, ETFs, and so on, and you would see almost complete all red or almost all red. Gold is down, right? That's supposed to be a hedge. The Barclay Hedge Fund Index, right? Hedge funds are supposed to be an edge. That's over 600 of the top hedge funds. They've lost money through August this year as well. Emerging markets ETF, the S&P, of course, I'm sure everyone's well aware of. Dow is in the same camp, right? Russell, same camp. You got the NASDAQ 100 really getting hammered. TLT bonds, right? Bonds used to be a hedge. And even Bitcoin, which was supposed to be this great market savior, has not been one, at least not of yet. So that's crisis correlation that's impacting your portfolios, the value of your real estate, your collectibles, everything for the most part has been hammered. Lots of reasons for that. I'm not going to go into it now, but it causes stress and strain on us investors, right? And if you're a trader, it causes strain as well. Not only is your own net worth, no matter how much you have, probably declined since the market started selling off, but your strategies, if you're an independent trader, we have many independent traders that also license our programs, have probably struggled. I know some professional traders that have absolutely done incredibly well, but most of the people I talk to that are traders that are prospects or clients of ours have told us that they are really struggling. What used to work doesn't work anymore. And why might that be? Well, we've had a regime change, right? So that's crisis correlation. That's why a lot of people are struggling. And fortunately, there's something we call IQ auto trading or auto trading with IQ that can help. IQ auto trading, just to sort of come back full circle on that crisis correlation chart I showed you before, this is the combo's performance. This is net of its license fees. Most of the data I've showed you today, we haven't taken out fees because fees vary by program and so on. This one, for this chart, we did take it out, and you see it's still up almost nearly 20% through August while everything else has gotten hammered. And that's the beautiful thing about trading automated strategies intraday.